Welcome to the Investing Show, where we discuss the news that matters to investors and get investing ideas to help you make more of your money. Joining me here in the studio, I've got Richard Hunter, Head of Equities at Hargreaves Lansdown.
Hi, Sam.
And Nick Moose Batsford, CEO of Tip TV. I'm Simon Lambert of This Is Money. Coming up later on today's show, we're going to talk property and the buy-to-let market. What's happened, what next, with Rob Ellis of Easy Property. But first, a quick look at some of the things that have been in the news recently. Now, one of those things is that investors have been understandably nervous over the last few months. There's been a lot of volatility, and they're thinking, is this going to be a good year? Is this going to be a bad year? I looked at some numbers before I came over here. The FTSE All-Share Index year to date is down 1.8% at the moment. So, are we going to see better things to come before New Year's Eve? Or worse? Richard, what's the mood in the markets?
I think it's still cautiously optimistic. You mentioned the all-share being down just shy of 2%. The FTSE 100 is down about 3% at the moment. Arguably, for either of those figures, you could apply dividends because obviously that's a straight line index. And if you apply dividends, you're left with a situation where the market, it's fair to say, is flat for the year. And considering the year we've had, when we had, it seems a long time ago, but concerns over Greece and what subsequently happened geopolitically, let alone Germany potentially slowing down, let alone China. And then, of course, you've got commodities and all. It's actually been quite a creditable performance overall. It's probably more worthwhile looking at the all-share to see what the market's been doing because, obviously, as we've mentioned before, the FTSE 100 tends to be skewed somewhat by the oil and mineral sectors. But as I say, given the headwinds that we've been seeing, and we're not quite there yet, we've still got a couple of months to go, a slight 2% dip or flat, including dividends, fairly creditable performance.
Yeah, I think so. I think what's interesting is that actually if you take out the big guns and you look at the mid-cap stocks and some of the small-cap stocks, actually they've fared a bit better. And that maybe makes me think that we might be a bit hopeful for a sort of a bit of a UK-driven rise for the end of the year. Maybe we could end up with our 5% gain.
But I think as long as we get October out of the way, that's always a nervous month in the stock markets. Historically, we had the 87 crash. I think if we can get the next 11 days or so out of the way, go into November, look for the Christmas rally, then it's sort of fingers crossed. You know, it's been a very, very volatile year, hasn't it? In terms of correction, 10% bear market, 20%, the amount of economic commentators who have been bullish and then bearish, then they're back on the ball. Very, very difficult to decipher exactly what phase we're in at the moment.
It has, hasn't it? And I must admit that the year has flown by. It's hard to believe that we're sitting here talking about the potential for a Santa rally. I've only just come to terms with it being 2015. But that brings us on to something you were going to talk about, Richard, wasn't it? Which is looking at the general state of profits over in the US, because we're into Q3 now over there. And also we've had some important numbers from China out, haven't we?
Yes, that's right. I mean, working the other way round in terms of Chinese GDP for the third quarter is expected to come in at 6.8%, came in at 6.9%, which is obviously a small beat. On the other hand, the previous quarter was 7%, which is slightly downwards. There's going to be an element of scepticism around the validity of that particular figure.
That's what I was going to say, was can we believe that number?
Indeed, because quite apart from the fact it doesn't necessarily marry up with some of the economic indicators that have been coming out of China, let alone some of our companies that are doing business in China. But even so, it was initially positive for the market on the basis that we can only work with what we've got, and on the basis of what we've been given, it looks like a hard landing is less likely than before. Although without question, and this partly leads into what we're seeing in the US at the moment, the very fact that we're talking about any sort of China slowdown has started to come through and impact US companies as indeed, and obviously as you know, all of these things are interconnected, the strength of the US dollar. So we've had a pretty mixed season so far. We're probably not quite into third gear yet, but there's been enough of a few companies dotted around where you can start to get a picture. And possibly as expected, because this has been set against low expectations, there have been a few disappointments. There was Walmart, for example, the owner of Asda in the UK and probably the world's biggest supermarket, which finished down about 12% last week. Separate issue there is whether that's a cyclical thing or actually the whole sector is changing and that's more structural. But we've had quite a few of the US banks coming through so far. And with the exception of Citigroup, they've generally been misses. So we've had JP Morgan, which was disappointing, Goldman Sachs, although the share price finished up on the day they missed, and more recently Morgan Stanley as well. That kind of speaks to the difficulty of the trading environment in the investment banking side. So it'll be interesting to see what Barclays say when they come up with their latest update, particularly if they were to confirm that the new boss is going to be someone with investment banking colours, because clearly you've got the two pressures here of, number one, it's a difficult time anyway for investment banks, and number two, is that something Barclays are going to edge back into, having slightly shied away from. But in terms of the rest of the year, what we've got to hope for is that the rest of the Q3 reporting season from the States really does start to pick up, because if you think back over the last few months, there haven't been many positive catalysts about.
No, we want to see, really investors want to see results showing that Main Street is doing well,
Absolutely.
even if Wall Street is struggling with all the difficulties that banks have right now.
But just to add on the GDP from China, that must have been a massive relief for the marketplace, because there was rumours it may come in at 3%, 4%, 5%. The fact that it came in against what was perceived to be there or thereabouts, that's got to sell newspapers and make people more comfortable that perhaps, as you say about the hard landing.
It does, doesn't it? And I mean, obviously, the GDP, you're looking at a backwards-looking figure, aren't you? And it's really what happens in the future that matters. But we've already seen some of that backwards-looking stuff affecting UK companies. There was a story we had last week, Jaguar Land Rover has seen its sales fall in China. That seems to say the consumer's suffering a bit over there. We had Burberry, which said, things were suffering over there. And maybe there's just a little bit of a loss of appetite for this, high-end luxury goods. But then I saw another story the other day saying that China now has more dollar billionaires than the US does.
Right.
Which is astonishing. So.
Wow.
Yeah, sure. As investing on the whole, of course, it's trying to see through the current noise and having a look at the longer trend and whether that's still in place. And you have to say it probably is for the likes of China and increasingly India as well.
Well, one thing going back to America that we have imported from the States in recent years over here is Black Friday. Yes, it's everybody's favourite new shopping day, where there's a punch up in the supermarket because someone wants a cheap telly. But
that's what I was going to talk about.
Is it a fad? Is it a real thing? Are shops making more money out of this? Nick?
Well, this is the weekly, or fortnightly piece on the newspapers, and your pal Simon Watkins, the city editor of Mail on Sunday, headline, "Frenzied Sales Fest is simply folly."
Indeed.
The retail sales frenzy known as Black Friday is a clear example of outright madness. Sales forecast to top 1 billion on that one day. 1 billion. Last year's day being described by one city analyst as a disaster for retailers, but they're back at it again. Tesco's, Asda, PC World, Amazon are the type of people who expect to be involved in this. They reckon Amazon might actually start discounting on the 1st of November. So not even waiting to the 27th. And they're saying it's now part of the national calendar. Is it part of your national calendar?
It's only been around for about 2 or 3 years.
So that's the headline, it's part of the national calendar. It's a huge amount of sales we registered for that day, and they're saying it's a huge mistake for retailers and one they can surely not afford to make. Okay, plenty of experts, including the head of marketing at Marks & Spencer, attest that Black Friday does not boost net sales. The point, many sales were ones that have simply been put off from another part of the year. So I guess if you're going to buy a washing machine, you might wait for 3 months if you thought you were going to get...
Or indeed brought forward from Christmas, in which case you've got the Christmas figures for the retailers, which then go and suffer.
Yeah, well, I think the retailers have sandwiched themselves, and I think this is a problem for the British High Street and British retailers, is they are sandwiching themselves between 2 discounting periods, and that's their best shopping period of the year. You've got the Christmas period, and what's happening is they're discounting early with Black Friday, and then they're discounting before Christmas now, rather than waiting for the after-Christmas sales. So like Richard says, you've got all these people who would go out shopping for their Christmas presents, but they think, I'll either try and pick it up cheap here, or I'll wait until the very last moment.
We'll just finish off this article. It's about crowds of ill-tempered shoppers pushing and shoving. It's difficult to retain a quality brand if your shop is the venue for the annual scrum. And I didn't actually think about that, because you see people fighting in Harrods or whatever, and it's not good for the brand, is it? I wouldn't have thought, seeing people sort of fighting. Originally, going on sale was about stock management. The new use sale was obviously getting rid of everything that was unsold during Christmas, but they say now everything's on the internet. In terms of the stock management, so sophisticated, do you actually need to have that type of event? And just to wrap up, okay, investors in the retail groups taking part should be worried about the spiral of discounting. So he's actually saying this could have an impact, a negative impact on the share price if your holding is one of those companies.
Won't do a lot for inflation either, will it? If we're
No.
even white goods are coming down in price as well. But I mean, this was it's strange that it should have taken off in the UK now. I mean, this is a very historic thing in the States. Black Friday related originally to the traffic jams which would have been caused around you know, the major cities. That's what the police used to call it, because they knew it was going to be carnage. And of course those were the days when you didn't have the internet and when you could actually make a big drama and a big visual impact out of having people queuing out the door. So the fact that we've adopted it now so late, when you can do shopping online 24/7 anyway, obviously keeping an eye on the prices, it's a strange time for us to have kind of joined the party very late indeed with the Americans.
It does. I think the other problem is that it causes a logistical issue around delivering the stuff. You get all these massive orders all in on one day, and then all the retailers have got to try and deliver them, you know, over the next sort of, you know, 3 to 5 days, which causes, you know, real problems for them. And I think actually, if I was looking at the retail space and looking at investing in individual companies, I'd be looking at who does online well, but also who's got that delivery thing nailed. Because, you know, delivering these goods costs stores money, and there's this argument over free delivery, click and collect, how exactly do you do it? And I think that's going to be a very interesting space where things play out over the next 3 years or so.
Or look at entities where they're actually involved in the return of the merchandise. So they actually, the merchandise doesn't go back to the entity, it goes to a third party who basically then give it back.
Because those returns cost them a lot of money.
And that's big business.
And the one that's interesting is Next, I think, for example. Next has done very, very well over recent years, and it doesn't really indulge in all of that sort of discounting madness as well either. So. Right, well, that's it for the news for this show. Coming up after the break, we've got Rob Ellis of Easy Property to talk to us about what's going on with the property market and buy-to-let. Join us then. Welcome back to the Investing Show. Joining us here in the studio, we've got Rob Ellis of Easy Property. Rob, welcome to the show.
Thank you.
Now, Rob, you've come to talk to us about the property market. How's it going, about buy-to-let as well. This is a bit of a departure for the Investing Show. We're normally talking shares and funds, but we thought that there's a lot of people out there, many of our viewers, who will be invested in property, and the property market is obviously fundamental to the UK economy. So how do you see the property market at the moment?
Well, I mean, to pick up on your point, there is about 4 million investors in the UK are now sort of landlords, so it's creating a large chunk of the housing stock for the UK, which I think is putting some pressure points on it governmentally, hence why all the new regulation and restrictions that are being imposed and the advent of the build-to-let.
So what's happening with buy-to-let if we just look back at the recent past and the changes that are coming in for the future?
Well, I think there's a phase of the government sort of the way they're looking at buy-to-let as a bit of an issue. It's very difficult to legislate with so many different landlords and controlling small volumes of properties individually. So of course there's now the sort of the advent of build-to-let, which is trying to make it a lot more fund-orientated, alternative methods of investing in buy-to-let rather than just, you know, the whole sort of illiquid form of buying individual properties. So I think that's something that is being pushed quite considerably. But the market's strong, the market's growing, still yields are getting a little bit better outside of London. Marketplace in London is still strong. Westminster grew incredibly well last couple of months. So yeah, it's a good place to be right now.
And I think that with the buy-to-let market, I mean, buy-to-let was obviously invented to increase the number of private landlords, wasn't it? And when buy-to-let was brought into being, there was this idea that it should be treated as a business. And one of the big changes that's coming in is tax to mortgage interest. Now, landlords at the moment can offset their mortgage interest against their rental income tax bill. And that's long been a bugbear for critics of buy-to-let. People say, well, I can't do that with my own home. Why should a property investor be able to do it? And the principle behind it is obviously that you only pay tax on your profit. Now that's changing, isn't it? George Osborne brought in changes for that in the budget. Do you think that's going to affect a lot of investors?
I think it's going to affect a hell of a lot of investors. I don't think it's a very popular move by anyone in the property industry, that's for sure. And again, I think it's pushing more towards professionalising the buy-to-let market as a whole. Obviously, there is a big issue where there are now so many investors that have got property as a big chunk of their portfolio for their pensions, and that has to be balanced pretty carefully.
Because I think obviously if you're a property investor or a small landlord, say you've got one property or two properties and you've had it for a long time, you know, you probably bought when prices were much lower. Those are the people who've seen the bumper gains, and your mortgage payments are probably likely to be quite low unless you've obviously refinanced to take more money out. But it's more the people who've invested relatively recently who might be barely breaking even that this is going to hit, isn't it?
Yeah, that's right. I mean, I suppose the way the market was, with interest being able to be offset, did encourage people gearing up and taking as much money as they can to buy more properties. At the moment, I'm not so sure that is going to carry on being the case, and I don't think it would necessarily be a bad thing seeing some liquidity coming into the market with some of the buy-to-let investors putting some of the first-time buyer properties back in to start that, bringing the price down and hopefully keeping the first-time buyer market down a bit.
That could obviously put some liquidity back into what you might call the normal housing market.
Yep.
But that could also come at the expense, of course, of people who were thinking of buy-to-let or coming into buy-to-let, let's just say for argument's sake, in the next 18 months to 2 years, which also, of course, could be accompanied by interest rate rises or a rise. They're all fairly big negatives for the sector, or not?
They are negatives. I mean, the difference is, there is still a massive increase in capital values at the moment. I mean, anything below £2 million in London is certainly flying, and across the country, still property prices are going up considerably. So the offset probably against the interest issue is being countered with sort of still capital increases and still very good investment terms.
And I mean, certainly that yield on a buy-to-let looks very attractive to someone who's looking instead at a savings account with sort of 3% on it. Obviously, a savings account, your money is protected, but then with a buy-to-let, you've got the opportunity to make that bit more money. And I think it's very much a British thing, isn't it? It's we like property and we like what we know. So for people who are landlords or property investors, what do you think they need to be thinking about right now?
Well, like all things, when some costs go up, you've got to bring others down. So the obvious way to do that is to look at the agency fees and start seeing how you can bring those down. There are other different methods now with online agencies that are much more cost effective. Obviously, we know all about those.
Is what Easy Property does.
Yep. So that can increase the yields quite considerably and should be able to offset compared to some others. But obviously, it's interesting that 50% of the market manage their own properties. 50% of transact and let properties through classified adverts, for example. So there's a lot of landlords that are out there trying to cut costs down as much as they can anyway. So this may have a slight effect on those guys, but invariably, the professional landlords, the ones that are using agents more, there are other ways of bringing prices down.
But what scares me is the newspapers are always about ticking time bomb of interest rates rising. This is geared money, isn't it, which is dangerous.
Gearing is dangerous, yeah, absolutely. And I think there are some aspects to it which people just don't actually recognise a mortgage as debt, which is a worry. But there's a lot more legislation now to say about the amount of loan to value that you can actually borrow against. So I think that's controlled things a lot. The actual return, so you can only borrow 135% of the rental income, so it's got to have 135% cover, things like that, which does control the amount of money that is actually going into it compared to how it used to be. So it's a much safer environment today than it was. But still, it is. You're borrowing an awful lot of money to invest in a business as such.
But I've sort of got friends who are non-property people, and they've all got buy-to-lets, and they go, fantastic, I've got this 2-bedroom yielding 3%, 4%. But I'm thinking, I've seen interest rates at 20% in the UK.
I think we'll all agree that's not going to happen anytime soon, though. You're not going to
Agreed,
get 20%.
But never say never.
Never say never, absolutely. And the property stock levels are historically still low, so we've got a lot more people and a lot more demand for housing stock. It's keeping prices going up. There is that sort of concern that rental yields are still very low, but then I guess they've been low for a very long time as well.
I think when I look at buy-to-let now, and I think in all the time that we've been covering it, This Is Money, I think the one thing that we have always tried to say to people is if you are going to do it, if you are going to invest tens of thousands of pounds of your money into this, basically you need to be thinking long term, but also do it properly, because I think there's a lot of people who get into buy-to-let and they don't think that much about what they're doing beyond, well, that person made all that money, I think I'll do it as well. So I think the things that I would be suggesting to people is look at your mortgage. So are you fixing your mortgage, and how long are you fixing it for? There's some really cheap 2-year fixed rate deals out there at the moment, but at the end of that 2-year period, your rate could jump from under 2% to nearly 6%. And on a £150,000 interest-only mortgage, your payments would go from £230 a month to £730 a month, which is a big jump. And then I think it's, as you say, looking at the other costs that you can crack down on. Are you making sure that you are keeping those costs low where you can? And then also, are you making your tenants happy? Surely that's a very important thing for a property investor, isn't it?
The most important thing for a property investor is to not have voids. A void kills all your yields. A month, 2 months without a tenant in there paying any rent and has the knock-on effect across the year. So you've got to make sure that churn is kept to a minimum. You don't want to keep getting new tenants in there. So the best returning properties are basically the ones that you've got a tenant in for 2, 3, 4, 5 years. And actually, do you really then need to push the absolute envelope of the maximum rent that that property is absolutely worth? Sometimes it's worth just keeping that just off the top a little bit to incentivize that person to stay, because the cost associated with moving, now I'm doing myself out of a job, but it is that cost there absolutely kills the yield.
That long-term relationship that really
and if you can get a tenant in for 2, 3, 4, 5 years, then that tenant's happy, you're happy, they're generally looking after the property better, and you don't have extra costs there as well.
So the build to let scheme, which the government may or may not be getting their weight behind, how long, in your expert opinion, is that going to take to start rolling out before we see a difference?
It's going to be another 12 to 18 months. We've done quite a lot of work on that sector. We've spoken to a lot of the funds that are actually trying to invest in it, but obviously, like anything, you've got to build it, and building doesn't happen overnight, and you've got to come up with the sites and then start the process. So it's a 2 to 3 year process. I think we're already a fair way into that, but it would, if it was there tomorrow, it would be great news, because obviously there's a huge demand and not a lot of supply. So if we could get more stock into the market now, it would be great.
Richard, looking across from this, from the property market to shares funds, the house builders, and also the UK's cyclical economy, which is very dependent upon the property market, how do you see things panning out at the moment there?
Well, we've seen from the performance of house builders in particular, I think we're back to 3 or 4 in the FTSE 100 now, which there hasn't been for some considerable time. The likes of Persimmon, Barratt Developments, and recently promoted just last month Berkeley Group as well. That's evidence in itself of just how strong the share price performances have been. But they're in a complete purple patch at the moment. You have got the UK on a recovering trend. You've got historically low interest rates. You've got the supply-demand imbalance. If you had a number of boxes to tick as a house builder, they're all being ticked for you. Obviously, that goes with the caveat that will change. So it then becomes a question of, OK, when UK interest rates rise, it's not going to be too fast. But by the same token, we're already starting to see some sort of slowdown in the UK economic recovery. And bearing in mind that the market's a discounting mechanism, always looking to predict what's going to be happening a year or 18 months in advance. It needs a very close eye kept on it at the moment, especially bearing in mind valuations of shares anyway, which obviously have been taking a real upward trajectory over the last 18 months, 2 years.
Nick, how long do you think house prices can keep rising for? They'll have to fall one day.
I'm really sceptical right here, right now. I'm thinking straight away of a project like Battersea, and one of our mutual colleagues was saying that we've got a lot of international investors basically putting deposits down. You're seeing these massive currency swings in these emerging markets. Very simply, if they're devaluing against the US dollar or the Great British Pound and they're putting the deposits down, then suddenly they've got to find more money. And property's all about sentiment, isn't it? OK, I feel great if my house is going up, but suddenly if I see a project go badly wrong, it has a knock-on effect. And we all believe that property is going up forever at the moment. I'm sceptical.
Rob, outside of London, obviously that overseas investor thing falls away a bit. I mean, I know it's happening in some places like Manchester and Leeds and Birmingham.
Yeah.
But if you look at those regional property markets, take London out of the equation, which is completely mental, if we're going to be entirely honest.
Yep.
Take London out of the equation. How do you think the property market's going to fare over the next few years in the UK?
Again, I can't see anything other than being a strong market for the next couple of years. As long as we do have continual low interest rates, it doesn't have to be quite as low as it is now, but as long as it stays relatively low, it is just demand. We have got a ridiculous amount of demand and so little supply that until that changes, the market is going to be strong, or unless, let's say, there's another third factor into that, which we can't necessarily predict. But again, buy-to-let is a market that is over. You've got the professional landlords, you've got amateur landlords who just want to buy properties as an investment. You've got accidental landlords. So you've got such a different range of people that are ending up with properties to rent out. That I think it's going to be an interesting time. But those properties are much preferred to be rented out than sold at the moment. And it's all the time that's taking place and people are holding on to properties. They're not got the liquidity in the market. You're going to have property prices going up, and say there's enough rental demand for people to keep pushing the rents up as well.
Rob, that's all we've got time for, I'm afraid. Thank you very much.
Thank you.
Very illuminating discussion. Rob, thank you.
Thanks.
Richard, thank you.
Pleasure.
Nick, thank you. Join us next time for the Investing Show. Goodbye.